Hello. In this video, I am going to give you a little demonstration on how to develop financial statements, income statement, balance sheet, and statement of cash flows using something called the percent of revenue approach. It's a little bit misleading because we do use a couple other ratios, but you'll find that sort of the key element of that for the business opportunity is that we determine many of the inputs for the income statement, pretty much everything for the income statement except for depreciation, interest expense, and many of the elements of the balance sheet. We determine those based on revenue. The first thing, obviously, you guys have already developed a revenue estimate that extends out for however far it extends out. You see, I have mine for out to 10 years. I've already created my income statement, balance sheet, and cash flow categories. These categories are going to be different depending on what your business model is. So, for example, I have food cost, I have direct labor, I'll have period costs, and I put notes around some of these about what they are and all of that sort of stuff. Similarly, the percentages will be different. You need to research your industry and figure out, maybe find the financial statements for a company that's like what you do that has published financial statements. See what the categories that they list on their financials are, and then calculate the percentages. And so I have done some research and found that the primary categories in the restaurant industry are food cost, direct labor. Both of those are variable in some sense. And then period cost. A period cost is a cost that is just basically the same amount every month, let's just say. You can ratchet that up or down from month to month, obviously, but it's not based on a particular usage. And so we'll kind of start out with that. So, in terms of food cost, my industry, they expect a food cost of about 25%. Labor costs somewhere in that same range. Again, we're going to build this dynamically. So if we determine that we've gotten one of these assumptions wrong, we can just change them. So it's probably less important at this stage that you feel like I have the best assumption in there, and more important that you have something in there that you can use to build on. Depreciation, I'm assuming a 10-year depreciation straight line. I know we could build out a full depreciation schedule, but this is not an accounting class, and so we're not going to do that. I assumed borrowing at 8%. Again, later on in the course, we'll talk about how to think about what your real interest expense is, but that's what I've put in, and I've assumed taxes of 25%. Depending on your structure and so forth, those taxes may be different, but that's what I'm assuming right now. From a balance sheet standpoint, we've got cash and equivalents. And again, ordinarily, when you think about how much cash you need to have on hand, you think in terms of the kinds of things that you might purchase and so forth. I've started out with the assumption that what I need is the amount of amount of cash equal to the revenue that I would have generated on a monthly basis by the time I sort of reach my peak, which is in month 12. You could since that's a formula that I've tied in. I didn't highlight it in yellow. I guess I could. You could set a different number, but that's what I used as a starting point. I assumed accounts receivable of 0%. We're just going to pay everything off. If you were going to do an accounts receivable, you would need to do that on some percentage of monthly sales. Inventories. This one is not actually on a sale basis. Inventories are based on food cost, and so it is a percentage of the monthly food cost. I set it at 50%, and so for me, what that means is that I will typically have about 2 weeks worth of inventory. That may be a little bit long, and I may lower that at some point. But at any one point in time, I don't see any reason why I would have any more than 2 weeks worth of food on hand. Property, plant, and equipment, I put in a straight $300,000. Now, how did I get to that? What I did was basically go look at what the revenue is out, annually going out basically into year two. Okay, and basic, thinking in terms of that roughly half of that. Well, actually, that's what I could do. That's what you would normally do in a sort of this thing. There's an approach called an asset turnover ratio, and so you could go look that up for your company and use sort of a stable number, maybe out year two or something like that of revenue, and see what your asset investments are. I actually did something slightly different. I just built this up from the ground up. Basically said, look, I'm assuming I'm going to need a certain amount of money for land and building, and then I'm going to need money for equipment, and pretty much just based on experience, pulled a number here. You can see that number, if you wanted to calculate it, we'll just kind of put something in here. It's equal to that divided by sort of this, and so 38%. 39, call it. I could just as easily have gone out there and said, it's equal to 40%. And basically say that it's 40% of whatever the year two revenues are. So we'll go ahead and do that. I don't have a strong base for why it's 40% at this point. But in your instance, you might be able to find something that's more specific to your industry. In terms of current debt, I am going to go ahead under current liabilities and have current debt. For me, I am not putting that directly as a ratio of sales. I'm putting it as a ratio of the amount of cash that I'm starting out with. And so 50% of the cash that I need, I'm going to, for operations, I'm going to finance through current liabilities. I could actually do total assets and do that. We'll just see. That's not an unusual thing to do, is to basically take out a 1-year loan to finance this, particularly at the beginning. You may have to pay a little bit higher rate on it sometimes, sometimes not, but they're more comfortable with the idea that, hey, it all comes due in a year. Long-term debt, taking out a 10-year note that will be equal to 80% of whatever the fixed assets are. And then stockholders' equity. Right now I have a formula in here that says that my stockholders' equity will be, let's call it B42 plus 37. So it will be however much money I need for fixed assets, and so it's not 40% anymore, but I will figure that out. But it will be basically however much I need for fixed assets plus current cash, less however much I've done in borrowing. So I'll remove that for now, and we'll actually solve that out for month 0 and going forward. And so you have capital contributions. There is a category for retained earnings that we'll add, but there's no formula here. Less capital distributions, that's dividends. Right now I'm going to assume that we're going to distribute 0% of our cash flows, our net income, I should say. And so I've set it to 0, but we could always move that up. Cash flow statement, there are no real percentages here. The reason the cash flow statement is here is that's what allows you to determine what the cash balance will be from month to month. What you start up with, how the cash changed. It either went up or down over the month, and therefore for the next month. So there's not a lot of decisions here. It's just pulling the other information together and saying, oh, based on that, this is your actual cash flows. So we're going to start out by just doing a first month and getting some formulas in here. So for revenue, we're just going to go grab the revenue. And I apologize in advance. This is a little bit longer video just because it takes a little longer to explain. Variable costs are equal to whatever this percentage is. So I'm going to put a dollar sign on it, times whatever the revenues are. Okay. Didn't like that formula. And you'll see we'll make a few adjustments to that as we go forward. Another thing I can do is I can put a little dollar sign in front of the row 21 where the revenue is and drag this formula down. And by doing that, what I'm doing is saying, just calculate the percentage of all of these. So for example, if this had been $1,000, it's now calculated all that. Well, it's not $1,000, so but that just is a shortcut in terms of how you can do all of this stuff. Again, depreciation I can't figure out right now. Interest expense I can't figure out right now. EBITDA is just revenue minus the sum of these expenses. EBIT is equal to EBITDA minus interest when we figure that out. Pre-tax income is equal to EBIT minus tax, or minus interest. Sorry, the other was depreciation, and this is that. I also, I like to kind of highlight all of these things and make sure that we're on the same page about what's a total and all that sort of stuff. So I'm going to do that. And net income is equal to pre-tax income minus taxes. So we'll go ahead and fill that out for now. So we have most of the formulas in there for the balance sheet. We even know that the taxes are equal to whatever this rate is. So again, we'll put the little dollar sign because it'll always be that. Times whatever the pre-tax income is. So we can fill that one out. So as of right now, we've got these two. I'm just going to put them a little color. We've still got to figure these two out. Okay, just a little placeholder. We'll take that away once we get them sorted out. Now, down here, the challenge really on the balance sheets are the assets. If we can figure out the assets, we can sort of figure everything else out. And so let's start with the cash and equivalents. In the cash and equivalents, what I'm going to do is I'm just going to say 100% here. All right, so it's a percentage now. And it's 100% of and if you'll recall, I'm going out and basically saying it's 100% of year 2 revenues. 100% of, month 12 revenues. Oh, my formula somehow broke down here. So equals that times month 12 revenues. Okay, and again, you could put a different number in there if you want. You could do it based on a percentage. You could just plug a hard-coded number. That's what I'm doing. My accounts receivable are, I'm assuming 0. I still need to put a formula in here. Equals 0%, put the dollar sign, times whatever the revenues are. I feel like I've somehow, I did a bad thing here. Sometimes when you have this, it is not a good thing when you're hiding columns. So let's do that. Sorry. Then equals 0% times whatever the revenues are. And again, if we decide to have that, we could always bump that up. Inventories again are a percentage of food cost. So it's equal to that percent times monthly food cost. And monthly food cost we have up here. So it's really nothing right now. Okay. So we're making some progress here. Now we would say total current assets equals the sum of all of that. Okay. It's not terribly sexy right now, but remember we're still in month 0. We haven't even opened the doors yet. All right, what about fixed assets? We said they're going to be 40% of the year 2 revenue, so equals 40% of year 2 revenue. Idea behind making that a percentage in that case is pretty straightforward. Somehow times, why did I not get that? Anyway, making it a percentage in this case is basically a way of saying that, look, if I'm going to assume the business is bigger, then I'm going to assume I'm going to need more building, more equipment, all of that stuff. So if I change the revenues, this all changes. Same thing here. We want the dynamic sheet, so we want it formula driven as much as possible. Now I'm going to do something with this because you rarely go out and borrow at that exact amount. I'm going to do a rounding. I don't know if you guys have ever seen this before, but I'm going to do it to the nearest $1,000. And so when you want to do it to the nearest $1,000, you put a minus however many decimal places in there. Okay, so that rounds it out to $308,000. So formula driven. Depreciation on that. Again, all I got to do here is basically go pick up whatever I put as depreciation above on that one. When we get to the next one, we'll have to do a little something different. But we now have enough information to figure out our depreciation. So let's go up and do that. Honestly, I'm going to start out with a depreciation of 0. And I realize that that's a plug, but the deal is right now we're on a monthly basis. And on a monthly basis, you don't depreciate every month. So we're going to carry that on out for all 12 months, or 11 of them. And in the last month, we're going to take whatever the asset amount is. And so that requires me to do a little something here. I'm going to do that same sort of equals and carries out. No particular reason in the first year for us to get more assets because we've sized our assets to year 2. Okay. And so depreciation wise in month 12, we would say it's equal to whatever that is divided by 10. Sorry, should have put divided by this number. Right? And so by doing it by that number, what we do is allow ourselves to say, well, if we wanted it to be a 15-year depreciation, we change that and this changes and gets smaller. So again, nice for us. I'm going to just put a little, I like to put a little, whenever I have a formula change, so I do something different on the way out, I like to put it in a little shade so that it reminds me that the formula here is not the same as the formula here. Okay. So guess we can go ahead while we're doing all this and let's just drag all of this stuff to the right. Out to 12 months. There you go. So we've got the depreciation. And since we got the depreciation, we can now do the EBIT. So then now we need the interest expense. That's going to be, we got to fill out the liabilities first before we can get that. So we're going to wait on that one just a second. I am going to go ahead and pull these two values. I'll just make sure I set them up right. Yeah. I'm going to pull all of these values to the right for the 12 months so that those fill out properly. We aren't going to pull the cash yet. Doesn't make any sense to do the cash yet. But lo and behold, we've already built out almost all the income statement. All we really need is the interest information, and we will be good to go. I'm just going to pull that out as well. There you go. So we're still lacking the interest information. We'll get that here in just a minute. We've built out the asset portion of the balance sheet somewhat. We need to get to accumulated depreciation here. Okay, so in this instance, we just said it's whatever the number is at the top, the depreciation at the top. That's not exactly true going forward. In the next period, it's actually equal to whatever it was before plus whatever's at the top in depreciation, because it's an accumulated amount. Okay, and so we carry that formula out, and sure enough, it's 0, 0, 0 gets to that, right? Just kind of give you a quick preview. We'll go ahead and pull this out to year 2 so you can see. In year 2, things grow a lot, obviously. Food costs grow, everything grows, lots of things grow. I'll go ahead and pull this stuff out so you can see this real quick. The accounts receivable obviously doesn't do anything. Look how the inventory jumped up. That's not good for us because we wanted it to be 50% a monthly, and now this is 50% of yearly. So we're going to take that whole thing and divide it by 12. That's going to be the new formula going right. And since we did that, we'll flag that as, oh, I made a formula change there. And it's good that we made the formula change there, so that's fine. Okay, interest expense, we're going to make an assumption, very much like we did with the depreciation, that the interest expense is paid once a year. And so what we can do is basically for the first part, we can do this. Just copy it down, okay? And what we really need is a schedule for the interest expense going forward. Okay, to get that, let's talk about our liabilities. Current debt, we're going to borrow equals this amount times this amount. So that's our starting borrowing short term. Okay, principal payments on the debt. Again, this is what we would call a current debt. We're going to pay that off once at the end of the year. Okay, so I can just go out here and basically say that's going to be equal to this, the principal payment, and for everything other than that, it's going to be 0. Now, technically, that's a hard-coded number like those are, but we don't have any reason to. I'm just going to remove the fill on those. We would never do a sensitivity analysis on those. So then we would have the principal payments less the accumulated principal payments, so you have to get the accumulated ones. So again, here it's equal to this. The next time over, it's equal to whatever the last value was plus what the current value is, because that's how you accumulate. Drag all the way over, and sure enough, there you go. Net long-term liabilities equals, well, let's do this, I guess, first. We're not going to borrow anymore in the short term. That's the whole point of it being current. So right now, we're saying we're going to borrow at the beginning and have enough to get us through the year. And so now we can say that our net liabilities are equal to the current minus the accumulated depreciation. Drag that over, and you'll see how that now goes to 0. And so, of course, the total current liabilities are just the long-term, or the net. It shouldn't be long-term. Why does that say that? Short-term debt. There we go. All right. Or we'll call it current debt. That's what we'll do. We'll just call it current debt. All right. And so we've got the principal portion of this. We don't have the interest portion of it. We can go ahead and just assume that the interest portion on it, again, which is only payable in month 12 in this case. So it's equal to whatever the debt amount was times that, and we'll put the $sign up because we're going to want to carry that over. So actually what it's equal to is we'll just leave it as that for now. This one's a little bit tricky. I can explain that to you. The real question becomes, are we going to continue to refinance and just hold current debt over and over and over again? If we are, then what we really need to do is key it to this. If not, we should key it to the bottom. But we'll sort that out. That's sort of a business question for later. All right, let's solve for this long-term liability. I am assuming that we have an 80%, a loan that's for 80% of the fixed assets. Okay, and so equals this times that. So we borrowed 246,400 of the 308. So that's 80%. All right. And the way that long-term debt works, obviously, is we're just going to kind of carry that out. What's going to happen here is that we may determine that we actually, because of the way that things are going, that we need to have larger debt, meaning we need to take more debt because things grow and we need more assets. And the formula that I have right now ties back to whatever the plant, property, and equipment are. So I think that'll be okay. And the formula right now is for plant, property, and equipment. It's just reading back and saying do the same thing. Well, that's all well and good, but what we're going to do, extending out now, is we're just going to take this value and go out to year 2 and drop it in there. Now, since this was already reading off of year 2, that doesn't matter. But if we were to extend this out to, say, year 3, it's going to say, oh, you're growing a little bit, you're going to need more. And so that's sort of that notion. Now, I could, and I probably should, have calculated a real revenue, and so the growth would not be based on the other, but commonly we just assume that everything's going to get more expensive and that you're going to roll over your debt. So we'll leave that. Again, these are concepts that we'll discuss at a later date, but I just want to let you guys know kind of what's going on here. So now we need the principal payments on the debt. Well, to get to the principal payments, we actually need to get the full payments. So let's just go over to our loan amortization and build that. Let's see. Amount borrowed, and that's equal to this. Term, and that's equal to the 10 years that we said, right? So we'll just plug in 10 years. So if you make a decision to change from 10-year, you have to come over here and change it. Don't know why that's doing that, but okay. So we're going to highlight that as one that you have to be sure you change. Interest rate. We're just going to go grab the interest rate from over at the other side. Okay. And then we're going to solve for a payment. And in Excel, there is a formula called payment, PMT, and it's asking for the rate, so 8%, comma, the number of periods, 10, comma, the present value, how much you're borrowing, and that's all you actually have to provide it. And so what it says is the payment will be a negative $36,720.87 a year. So we can now build sort of an amortization schedule. So let's do a starting balance, payment, interest, principal, ending balance. Okay. So starting balance is equal to that. Payment is equal to that. Interest is equal to We'll make it so it's consistent. Negative that times 8%. And I'm going to put the little dollar sign there to lock that in. Okay, and so whatever's not interest must be principal, so that's equal to that minus this. And the ending balance is equal to the starting balance. In this case, we do plus because we made our payments negative, minus the principal. So plus the principal, really. All right, I'm going to format these so that they're the same. And probably a good idea to put the year. So that's in year 1. 2, 3, 4, 5, 6, 7, 8, 9, 10. Oh, not 120. So if we did this properly, we ought to be able to drag this whole formula over. And we didn't do something properly because it's not reading that. Let's see. Payment has to be held constant. That's okay. That's okay. Let's try it one more time. Starting balance. Starting balance for the next period is equal to the ending balance from the prior period. So we drag that over, kind of get us caught up. If we go all the way to the right, we should wind up with an ending balance of 0. We do. That's awesome. And so we now have an amortization schedule. Beauty of this, we now have interest payments and we have principal payments. We'll need the principal payments for paying down the loan. We'll need the interest for the income statement. So we can just go over, and because we built it out this way, we can just use it for each of our years. And so going to interest expense, I have that, right? Plus, we're going to go minus, because that's a negative number over here, minus the year 1 interest. So that's my total interest expense now, all right? And the question is, what's going to happen when we get over here? It's going to pick this up. That's 18,351 now, which is this interest expense. And the reason is because the formula, if you remember, has the interest expense for the current debt and the long-term debt. But right now, the current debt doesn't extend out that far. And so that's a business question we're going to have to make, is whether or not we refinance that at the end. Right now, we're just going to assume that the current debt goes to 0. Okay, so that's an assumption at this point. And so then there will be no principal payments. Where are those? 49. So I guess if we just extend all that out, since it's 0, wait a minute. No, equals that. I don't know why we did that way. We should have just done this as we're going to pay it off. And that way when we extend all this out, it's all going to make sense. Where's that coming from? In accumulated principal payments. All right. Sorry, I'm losing myself. I guess we just have to keep extending this out. So technically, our current liabilities, the principal payments on those, I'm a little lost. I apologize. We'll figure out what to do with year 2 when we get to that. I'll tell you what. It's just a little tricky on the current debt. So we go down to here. We've again got to figure out our principal payments. So we're just going to start out in month 12 saying that that is equal to the principal payment in our amortization schedule. It's actually equal to minus the payment, principal payment. So we're going to put that there. I'm not sure what that, just having no luck today. equals minus the principal payment. There we go. Okay, and it's 0 prior to that because we're just making the payments once at a time. And again, accumulated principal payments on the first month, it's that. Every month after that, it's equal to whatever it was before, plus the new payment. And so when you carry that out, we get to this accumulated. Net long-term liabilities is equal to your liabilities minus your accumulated principal payments. That's all good. Drag that out. Equals that, because that's the only long-term liabilities we have. There you go. Let's see. So how are we doing so far? We've got, and I don't need these numbers here, but I'm going to clear those out so it's not confusing. But we've got everything except for cash to be able to complete the total assets. I guess we need to finish out these. Net PPE, which is property, plant, and equipment, is that minus the accumulated depreciation. So a lot of this right now is just sort of tidying up the income statement. Total fixed assets, we only have the one, so that's just equal to that. All right. And the total assets will be equal to the current assets plus the fixed assets. Boom. 370.02. That formula can get dragged to the right. Bear with me for a second. I'm going to show you why I'm doing that. Total stockholder equity, capital contributions. Here's where we have to figure this out. Okay. In the first period, we're going to say that what we need to put in is the amount to cover the cash plus the amount to cover the assets that we're going to buy minus whatever we've borrowed as current debt minus whatever we borrowed as long-term debt. So we need 92.7 is what it comes out to. Retained earnings in any period, of course, or just the estimated, not revenue, sorry, net income for the period. So we're going to take that there. Less capital distributions, and we're going to say that that is equal to 0% times revenue, or sorry, net income. Why is that not moving? Okay, so the idea is that we would be paying out a portion of our net income, and that's just not going to happen right now. All right. So capital contributions are that. We're not going to keep recalculating that. We're making that capital contribution once. So we'll put that formula. Actually, that's not a formula, is it? That is just driven. But this is a change in formula, so I'm going to highlight that. Retained earnings, that formula is what it is, so we'll carry that over. All right. Don't need to keep carrying this formula change over. So I'll clear that out. Okay, and that's sort of that. And so now we can get to total equity, and that's equal to this plus retained earnings minus distributions. That's total equity. Drag that to the right. Just to sum up liabilities in that, we take the total liabilities plus total equity, put it together. Now, there's a reconciliation line here that I like to include. It's important to include. And the idea is that the assets equals assets minus that. And it should equal. And if it doesn't equal, we've got a problem. All right? And so where's our problem? Total liabilities. Our problem is that we made our total liabilities only the long term. It's the long term plus the short term. So we'll fix that. That wipes that out. We got to carry that fix over. There you go. Now, looks all good there. Look what happens when we drag this out. Got these big differences. The big differences are because we have not finished the cash and cash equivalents. And that's really probably the most challenging part for most people of this. So we're going to work from a statement of cash flows. Again, yours will look a little bit different. It will, the things that you add back will be based on the categories that you have up here in the income statement and so forth. So you may need a little help with this, but here we go. So receipts are net income. Okay. Sorry, not net income, equal revenue. We're going to do minus operating expenses, and that's equal to the sum of these expenses up here in the income statement. Okay. Less the change in non-cash working capital. This is probably the most complex thing. It's got to be the current non-cash working capital, and so that is equal to, remember, working capital is current assets minus current liabilities. So for us, that is equal to accounts receivable plus inventory. It doesn't include cash because we're ignoring that, minus current liabilities. Okay, so that's the current one. Prior one, in this case, was 0. And so the change is equal to this minus this. All right? It's the change that we want. Now, I'm going to go ahead and drag this over for the simple reason that the prior now is actually equal to whatever current was last time. All right? So we can sort of fix that. Drag those over. So right now we're doing pretty good. We got 2 months worth of the hardest part of it done. Interest paid equals, go up and grab your interest expense. And of course it's nothing right now, so that's okay. Equals taxes paid. We'll go up and grab our taxes. Okay, so that's good. All right. Very important step. You're totaling the cash flow from operations. It is equal to the receipts. And then the next line is a less. So you take that off. Less. You take that off. These are just used to calculate that, so you ignore them. But less interest, less taxes paid. Okay? And so what that basically says is, from a cash flow standpoint, we started out with nothing, and lo and behold, we've got $31,000 from operations here. Okay, where did that come from? That's the kind of the big thing, and the answer is, it comes from the working capital, right? That we're basically showing that we get here with some the current debt, and so this is where it's sort of picking up the current debt, all right? And then we don't get it again, so there we go. All right, so now from investing, sale of assets. Generally for us, we're just going to plug a 0 here. I'll put that in as a this, and we'll just set equal to that. If you ever have a sale of assets, you're just going to need to hard code that decision to sell the assets in here. There's nothing in our plan that will automatically imply a sale of assets. Okay, so if you ever come out here and say, oh, we decided to sell some assets, you could go hard code a number for that. Purchase of assets. All right, we did buy some assets here. Equals, where are those assets? Fixed assets, right? So this is the amount we bought. You're not looking at the depreciated amount, you're just looking at the amount you bought. All right, so you bought that. Now here's the deal. When you make the purchase, you want to be able to say, oh, it's equal to whatever that is minus whatever this is. And the reason is because you don't want to say that you just keep purchasing it. This is a cash flow statement, not a balance sheet. And so since it's cash flow, it's if you put this in here, it would be like saying we spent another $308,000, and we don't want that. So we're going to drag that out. Okay. And I've obviously ignored something here. Let's see. Because it shouldn't be working off of that. It should be working off of 42. I do this all the time. I apologize. Okay, so that's the change in that you're really interested in. All right. And we don't include any of the other assets in there, the short-term assets, because they're picked up under the working capital. So we get it equals total, so it's equal to this minus this. Okay, so that says that we lost some cash there, right? Because we paid it out. That makes sense. All right, and I'm going to go ahead and highlight these little bad boys just so that we've got that kind of color difference there that lets us know that there's an important number. And then last, we're going to do the cash flows from financing, capital contributions equals whatever that is in this case. And it is equal to the change in that, so this minus this in the future. If we ever did decide to go put more capital contributions in, we would just add them to the numbers up here, and that would be reflected down here. So right now we don't have a plan to put any more capital in. Cash from long-term debt, same sort of strategy. We're going to say, okay, well, long-term debt, we went out and got this much. And then equals this much minus this much. We didn't go get more. Less capital distributions. So that would be equal to this. Total capital distribution, and then again equals this minus this, because that's an accumulated balance sheet number. You can see that's sort of, you're getting a theme here. Principal payments on debt. What we want here are just the individual principal payments. We do not want the accumulated, because this is a flow. So each month we get what we paid out that month. So you just put that there. Again, doesn't look like much. That's going to show up out here as our first big debt payment. Okay, and then you got to be sure again, do your adds and lesses. So this is equal to that plus that minus this, and you get a value. All right, and we can drag that value out. Now, this is the moment where we cross our fingers and hope we did everything right, because sometimes I don't, and I just have to go back and figure out why. But here we want to do is equal to, and this is where you pay attention to the totals here. We're going to add. And what we get is this 6220, and that's what we're going to actually put up here. Equals, based on our cash flows, we got 6220. And it says, I don't like that reference. All right, so what's going on? $75.76, what? All right, shouldn't matter. So what we've got is a circular reference here, because we did this on the basis of whatever number we put up there instead of just plugging a number. So what I'm going to do is we're just going to go ahead and put the 62,200 up there. All right. I'm a little uncomfortable about that, but it's probably a better way to fix that. Just right off the top of my head, we're just going to do it that way. Okay. But for everything going forward, we're not going to do that. We're going to do what we're supposed to do. It's just there are sometimes these sort of circular issues with setting up the very first month, or the first set of cash flows. From here forward, what we should have, your current assets, your cash should be equal to whatever your cash was before, plus whatever your cash flows in that particular month are, your net change in cash. So it should be that. Okay? So we would drag that out. Now, if we did it right, which we clearly didn't, we would find ourselves with no reconciliation issue. So now we got to figure out what our issue is. Usually you can figure out that issue based on that this number looks an awful lot like some other number. Let's see, $1,500. Is that showing up anywhere? There's always something here. $49.20. Does that? Sometimes it'll be an exact number, and sometimes it'll be, oh, that was a change in something, and it sort of shows itself up that way. So let's look down here maybe. Something that changed by that amount. Operating expenses maybe. Nope, not really. No sale assets, purchases. Nope, that all looks good. $22,190. I'm going to have to take a look at that, and what I will do, because I don't want to just sit here and have this video run on, I am going to figure that out. I'll stop this video, figure it out, and I will post a second video that explains what I figured out that I did wrong and how to correct it. All right? So thank you guys, and there will be a follow-up.